All right. Good morning, guys. Monday, October 12th with the tradingology.com trading room. This is Dan coming at you. And I believe we have our best friend Dave from the Strong Market team also joining us this Monday. Good to see you guys on a new week.
Good morning, guys.
Hey, good morning, Dave. How was your exciting weekend?
Not sure I would characterize it as exciting, but it was a very pleasant weekend. The weather was pretty good. The weather was nice.
I had one where I didn't go to a wedding finally, so that's good. Not that it was bad before, but we're slowing down on the weddings.
No camping, no weddings. What'd you guys do all weekend?
I know, right? Just can't figure it out anymore. We did have a massive storm roll through, so watch out in a couple of days if that thing keeps brewing for you.
Okay, yeah, we'll keep an eye out for it. So holiday, kind of a holiday for some people, you know. Banks are closed today, so we've got probably, I would say, muted trading. Not sure how the volume is stacking up here.
Yeah, what we got? It's Thanksgiving in Canada for our Canadian friends and Columbus Day here, something like that.
Is it really? Oh, is it? Yeah, that's right. I think they do have their Thanksgiving kind of.
I think that's what's going on in Canada today. It's a holiday for them too.
Okay, gotcha. Yeah, so muted trading, I think, of course, natural drift is higher. Of course.
Right.
Of course, it's the momentum computers. They're saying, "Oh, the moving average is up, so let's grab some gains here." But I did see on the New York Supply Demand Index this morning a minus 919 on the New York SD.
Oh.
Yeah, I haven't seen it. It's moved up past it a little bit, not too much, but I did see that, and it kind of faded, and there was no offsetting transaction, so it looks like a large sale order came through.
Did it end up closing on one where we see it, or was it intra-minute?
No, it was there for a second and then disappeared.
Okay.
So I'll go down to a 5-minute chart. I don't think it's there, though. No. Maybe we'll catch it on a 2-minute. Yes, you can catch it on a 2-minute chart at 9:50 my time. So it's just a 30 minutes after the open.
I'm pulling up a 1-minute here. I'll swing it over. There's the one he's talking about. Negative 919.672.
Yeah. So somebody was in there selling. I didn't see any offset. I watched it for a while. I didn't see anything to the upside. So, but we're still getting some sort of a drift higher, but it looks like a big institution came in with a sell order there. Now, market makers, typically what they'll do is they will hold on to those positions if it's a large sell order and try to maybe get rid of it over the period of the day. And then maybe, I don't know, maybe even before the close, they'll try to get rid of it.
Sure. Especially on like you say, a lower volume day, it's much easier to affect it. So they might be holding on to those reins a little bit.
Yep.
Because we do see in the volume, it's really hovering right around that zero line. The internals, the issues have been drastically wild, but not the volume.
Yeah.
So when we break that down in the market timer XL, we see it's another day of spaghetti here with no real super bias either way, for sure.
Yeah, we're in that 50, 60, 70% level. It's just going to be kind of a drift whichever way the wind blows. So yeah, that was interesting. That was about the only thing that caught my attention this morning. Other than that, I mean, it is, I don't know, the rest of this week, have you checked the calendar yet to see if we got anything going on?
Let's pull it up. Looks like nothing for today. Just some CPI numbers coming out later this week.
Okay.
manufactured anyways.
Hmm.
Philly Fed Manufacturing Index. So a lot of manufacturing, a lot of CPI, some retail sales going on Friday is the only red ones. So no FOMC stuff this week. Premiere of U of M consumer sentiment. This last one on Friday. So only 2 reds. So yeah, not a I would call it, hard hitting potential there.
Yeah.
So the claims will probably be another. Let's see what they're expecting. I'm curious if they even have an estimate or a forecast yet.
Yeah.
810.
We're still, yeah. I mean, you're talking about close to 1 million unemployment claims every single week. It's still pretty bad. The thing that kills me is that I don't know where all the money is coming from to buy stocks. Pretty soon, all these, whatever forbearance or furloughed payments are going on are pretty much coming to an end in December. Now they could extend it again. A lot of the student loans are ending in December. But they could I mean, they could easily, the government could just say, we'll go another year.
Right. Change the rules as they go.
Yep, amend the rules. I mean, they had it actually back in March when they did the first deferment of the student loans. They said October, and then they said not December. And especially if we don't get a stimulus bill and we don't get a stimulus check, they might end up deferring it even further. So we'll see.
Yeah. Excuse me. It's the serious back and forth there for sure, where we're not doing anything until later. Oh wait, I do it right now at 10 o'clock at night. Now I want a bigger one than you guys want. So it's just a roller coaster of conversation there as usual.
Yeah. I think the Democrats are going to try to keep it off the table and try to negotiate harder and do whatever they can to prevent a deal to get done before the election. Because if they do, they can blame Trump that a deal didn't get done.
Right.
Yeah. So it's a little negotiating tactic that they're going to use to try to win the election. Hopefully, the American people are smarter and they understand that than what Democrats are saying. But I mean, still, it's a pretty good card to play. Right?
Exactly.
You can still blame Trump for anything.
That's their model for 4 years anyway. So why would they change now?
Yeah, exactly. The only other thing that came up on my radar this weekend when I was doing some analysis was the yield curve. The 30-year was up around 1.67, 1.68, and it hasn't been that way since about June or so. And as soon as it went to 1.68, okay, so it's about 1.6 there. If you go back to 2020, I think June was the last time it was this high, around 1.6%. As soon as the weather changes, my sinuses absolutely kill me here.
I know.
So it's gone, back in June, I think it hit 1.68. Yeah, there we go. So last time it hit that 1.6 level, it got slammed down and we went from 1.6 down to 1.43. Wow. I got all the way down to the twos. Yeah, it got down to 1.19. Yeah, so they slammed it down. The Federal Reserve or the Chairman Powell said, they're going to keep interest rates low for the next 3-4 years. So I could imagine on the 7th when we hit 1.6%, saying, okay, we got to turn on that spigot again, keep that interest rates down. We don't want any arbitrage opportunities here, so we're gonna keep that 30-year down.
Check.
Yeah.
So which leads us over to mentioning what you were finding last week, and you dropped it in the real-time update service that the Strong Market team provides, is a notion of an asymmetrical trade.
Yeah, so this is something that I've gotten more and more interested in over the years. I do I'm not, here's the real issue. In fact, this was kind of interesting, and I'm going to post this over to the real-time update service. I'm not sure if you can pull it up. It's kind of a long read, but what I did was I clipped this out of a book. It's called Trading Wisdom. And there was this guy who had taken $50,000 after he graduated from college. He had some money in he had something about a bar mitzvah. I don't know, something about, he got $25,000 in his bar mitzvah. Yeah, I can see that. And then he had another $25,000 that he borrowed from his grandfather. And all of a sudden he started trading with 4-to-1 intraday leverage, which gave him $200,000 in buying power. He estimated that, he would trade Yahoo, eBay, and Amazon, which are highly liquid and stocks that really, really move. He had some large share positions, 1,000 shares in eBay, and he was up to about $4,000 briefly. And then it turned against him. It went down 3,000, then went down 7,000. The long and short of it is that eventually, within 3 weeks, he lost the entire $50,000.
Oof.
So that is what is considered a symmetrical trade. So a symmetrical trade is something like, let's say, just like any stock right now, if you're talking about Amazon or something like that, if you're leveraging Amazon or you're leveraging Apple, any stock that typically moves pretty good, and you've got according to what the brokerage can give you, $200,000 on a $50,000 account for intraday trading, you say, oh, great, wow, it's like free money, right? So of all the traders that I've coached over the years, the biggest issue for almost every single one of them has been overtrading, taking much larger positions according to their capital that they have available, and then taking what the brokerage gives them as far as margin goes and leveraging that to try to make a lot of money all at one time. Well, it's a two-edged sword, right? So you can make a couple thousand, $3,000, $4,000, $5,000 a day. And I've done that with futures contracts, but I've also lost $5,000, $6,000, $7,000 a day. And then in the net end, I make more money than I lose, but it's not dramatically different than if I just bought 100 shares of the diamonds, or just, a much smaller position than using the leverage in futures contracts. So I figured out over time that some of my best positions were asymmetrical, and asymmetrical trading is very similar to, and I didn't say it was asymmetrical trading, but the beaten up stock strategy in the Wealth Masterclass is asymmetrical trading. And what that means is that there's so small amount of risk in the trade compared to the potential payoff of the trade that it's almost impossible to lose. And so I gave an example in the R2S of a option trade that's available to almost anybody at any time if volatility is relatively low, like it is relatively low today. It's not at the low, but it is relatively low, which means premium prices are fairly insignificant. So if you can bring up that, I don't know if you can bring that up or not.
Bring this guy back over to you.
Yeah. So in this trade, this is just an example of a trade, but it's something that happens quite frequently that you can get into. And here's the kicker of this thing is that right now we are in a, oops, turn off my camera. We are in a really strange place and time in the market. We've got an unknown election. A really, really kind of odd election going on right now because of all the health problems and the issues that are going on in the country. We've got an economic decline that is really significant, that's closing down, 50% or more of the businesses in this country. We've got a Federal Reserve that is buying up all of the government treasuries, creating a kind of a bubble in the bond market as bond market prices continue to rise. We've got a unprecedented low in interest rates. I mean, you're talking about 100-year low in interest rates. I think it's even hard. I think it's even longer than that. I think I heard Peter Schiff say something like it's over 1,000 years since interest rates have been this low. So it's really, really kind of a very strange time, right? So if I was going to do something that said, hey, look, I want an asymmetrical trade, which means I have extremely low risk with an extremely high payoff, but it has a very low probability of actually happening. But if there was any time in history that there was a potential for a dramatic decline in the market and a rapid increase in volatility, it's now, between now and the end of the year. There are so many unknowns and there are so many things. I mean, look what happened last Tuesday. All the president had to do was tweet that the stimulus talks were off and the market dropped 600 points in seconds. So the risk here is that, so the risk is obviously volatility it could be extreme. So for 700, I mean, well, this was on Thinkorswim. So basically you're talking about a $65 trade on commissions, but if you're doing this on Tasty Trade, the maximum is $10. So if you're and the maximum loss here is $765, including the commissions. And this is a vertical debit spread on the VXX expiring on December 18th of this year. So you've got a fairly short time period in which an event, whether it's a black swan event or any other kind of risk event that you're talking about to the end of the year, could happen. Now, if it goes, the maximum profit on this is $199,000 compared to a risk of losing 765. That's what I call an asymmetrical trade. Very low risk, floor, you can't lose any more than that. And you know, but the potential payoff is huge. I've probably done about 20 of these over the last couple of years. So far, only 2 have paid off. And I've done them on things like the US dollar, treasury bond, ETFs. I've done them on stock market. There's a lot of different places that you could do this. You could do this on individual stocks too. You know, one of the famous ones back in the day was Enron. I mean, that just completely fell apart in a very short period of time. Tilray was another one, cannabis stock that went up to like, what was it, $500 or $250 a share, and now it's down to like 14.
Right.
You know, so there's lots of opportunities out there to be able to do these kind of trades, but obviously, you know, 1 or 2 out of 20 or 30 are going to work out. Now, the thing about this is that you do not have to lose the $765 because once, let's say you have a window of opportunity, you have a potential time frame in which you're looking for this trade to pay off. And if it doesn't pay off in the time frame that you think it's going to pay off, you can convert this debit spread into a credit. And so, for example, on a paper trade, I don't have my paper trading account up, but on a paper trade, I did a SPY and I'm down about $700. Well, in order for me to recapture, all I need is 7 cents because I did 100 contracts. All I need is 7 cents back in order to break even. So out of the 20 that I've done over the last few years, I've broken even on like 18 of them. So they're very low risk. There's really not a whole lot of risk. Once the potential window of opportunity for these kind of trades passes, you convert it to a credit spread and you get the majority of your money back. So really the actual risk in the trade is less than $765. Even if you only got a couple pennies back, you make a couple $100 back. But for the time that it's available, you have a very nice, large potential payoff. That's asymmetrical trading.
I would say that's definitely the biggest risk to reward ratio I've ever seen in my life.
Yes. Yeah. In the stock market, it doesn't get any better than that. And here's the kicker to this thing. See, I'm doing the December 20th. I'm not doing it, but I'm is in this example, I'm doing a December 18th expiration date. It's a regular monthly, the 100, 140. So that's a 40-point debit spread. a 40-point debit spread for 14 cents. And you don't get, I mean, your risk is 14 cents, period. There's a floor to that. You can't lose any more than that. But it has a huge potential payoff. Now, the kicker is that it does not have to hit, VXX does not have to hit 100 in order for this thing to pay off big. All we need is some sort of volatility spike. If we get a volatility spike and the VXX jumps up to just 40 or 50, or maybe even 70 or 80, it doesn't even have to hit the lower long call on this debit spread. That spread will jump from 14 cents or whatever it is now up to maybe $2 or $3.
Right.
You just made, $20,000 in a very, very short period of time. So you just, in the VXX, you're just looking for a volatility spike. That's all.
Yeah,
It doesn't have to go all the way up there.
199,300 divided by 765 is a 260 to 1 risk to reward ratio.
Yeah, it's the only trade that I've seen in all the years that I've been trading that has a very low probability of paying off. But when it does, it's pretty amazing. It's low risk, low, there's a floor to it,
Defined risk,
$765, and you put them on, of course, when you think something really, really big is going to happen, either in a stock or in the markets. And then you don't have to watch them every day. I mean, it's such low risk. It's like, but the payoff is great.
I like it. It's pretty amazing. I can't believe you guys are quiet. Maybe they fell off their chairs looking at that.
Maybe. I put a few on every year, when I see something happening. So
maybe we'll save that for another conversation, but I think the next logical question there would be is how do you identify some of those opportunities, or what do you look at to say,
right,
this is a bubble or this is not normal? I'm going to put on a low risk trade that has a huge potential payoff in this amount of time frame or so.
Yeah, exactly. So, yeah. So I do analysis and macroeconomics, interest rates, stuff like that. And so, you put one on, and then what you do is, in order to convert it back to after this period that you're looking at as a potential black swan event or some event happening, if that passes, then you take off the short trade, which is at a profit, the short debit on the debit side, and then you convert it to a credit spread, and you just recapture, as much as you can. Most of the time, you can capture the entire thing.
Very nice.
So you're.
Andres is going to put it on.
Yeah. There's no reason not to, really. I mean, there really isn't. I mean, let's say you think the dollar is going to just drop like a rock. You think everybody says, hey, the dollar's going to drop. It's going to be, we're printing so much money now that there's going to be no value in the dollar. People won't have to pay their bills because all your payments are going to be deferred until maybe another year or something like that. So if you think the dollar is going to drop, well, just look at the out of the money long term. Now, these are long term options. Now, this is that I put example of this one is December, because we're in a pretty small time period in the election time period. But if I was doing something, let's say on the US dollar or interest rates, like the long term ETFs like TLT or something like that, I would do something much longer term, probably 6 months to a year. But typically I don't pay more than 20 cents or so for one of these longer term positions. 20 cents and under is ideal, because it's pretty easy to get your money back if that period passes and it doesn't happen.
Would you say there's like for that period passing time, is it, hey, I'm looking at, like you say, we'll just take the VXX one for example, just to keep it consistent. Anywhere between now and December, it might happen. So it's a decent bet. So would you say if it's, end of November, the election's been done, whatever's happened, we haven't seen a spike, or would you wait till like the week before, 2 weeks before? What's your kind of window for, yeah, this probably isn't going to happen, I need to convert this?
Well, yeah, so I'm waiting till the election. I'm waiting to probably a few days after the election. What I'll do is I'll just keep an eye on the prices of the higher strike VXX or the lower strike. Well, in this case, it's the lower strike VXX, so I can make sure that there's enough premium in there till the expiration that I can recapture some of that $700. And then I may not even want to put on, let's say I do 50 contracts, I might only want to sell 40 of them, and I'll keep 10 open just in case it does happen before the end of the year. But the 40 that I sell to turn it into a credit spread, it gives me enough to make my money back.
You make up the difference for the one you leave open.
Yep. And so I still got 10 long. So, there's lots of ways to play it. But I would definitely wait until after the election. And then maybe even after, let's say it's just the election is just a total mess and they can't even tell who's president for 3 days.
Right.
Right. It could be so close, or there's so many disputes about counting the ballots that we could go a week even without knowing who's president. That would be pretty weird. And that could lead to some pretty heavy movement.
Some large turmoil could happen there. Absolutely.
Yeah, so I'll look at the beginning of December, maybe even going into the second week of December. There's still probably premium in there because, it's the VXX and anything can happen. So people keep the premiums up pretty high.
Sure. Andre says, so what should we put on now? Several different ones, maybe? I don't know if we'd look at other than just the VXX at this point for that, I would say shorter term election cycle.
Yeah, it's kind of hard to say because there's nothing else really on the radar right now except a potential stock market decline. I mean, it's kind of early to tell whether or not we're going to get a black swan event in the stock market. I think Trump, as he's tweeted out, and he tweeted out again this morning, that, hey, everybody's 401ks are higher.
Right.
The stock market is up. It's all good.
Right.
So if he tries to keep the stock market up, we could see the stock market up till the end of the year. I think January 1st is going to change the picture, because if we still don't have a vaccine, we still don't have, once again, it depends on who becomes president, I think. But, we could end up seeing a very, very, sharp decline in January. So, yeah, I think there's a lot of risk between now and the beginning of next year.
Yeah, one could probably make an argument for a potential bubble. We've heard a lot of rumblings in the housing market too. So if there's something we could key in on housing, that might be something to look at for, a 6-month out trade or something. Who knows? I would research on that, but that'd be another candidate, I would say, Andre.
Absolutely. And if we get interest rates down to zero, which I think is coming, I think interest rate long term is still going down. TLT could go up quite a bit too. So it's another potential trade.
Oh, you could do the sim trade on the VXX before the election, absolutely, if you wanted to.
Yeah. No, I would. I mean, if you're going to do a, what does he mean by SY?
Sim trade, so paper trade.
Oh, okay. So you're talking about paper trade, not symmetrical trade.
So that's what he means. I should quantify. It was a Y and not an I. That's true.
Okay. Yeah. No, I wouldn't do a symmetrical trade on it. That's why we're not doing the VXX. The VXX is symmetrical trade. I mean, well, it's somewhat symmetrical, but there is a cap there. That's why I like the VXX trade so much, actually, because it is somewhat asymmetrical. There is a cap to the amount that you can lose on that. Okay. Yep. Symmetrical. So I wouldn't do, let's say I would not just go outright and buy VXX at the money calls or even in the money calls. That would be a symmetrical trade. It just wouldn't have the payoff. I wouldn't buy puts either on the VXX, thinking it's going to go down because there's too much volatility there.
All right. Well, I'm sure we'll have more discussions on that down the road, because that's going to be an interesting topic, I think, as people catch the recording.
Yes, I'm sure.
We
may not want to put this one out on YouTube. It's up to you.
What? 260 to 1? Andre says, so what's the bottom line here on the asymmetrical trading?
the bottom line is to keep, have a macro view. So have a macro view of the economy. If you think the dollar is going to drop, I think there's going to be a lot of volatility in interest rates, the dollar, and you can even go both ways. Let's say some people think the dollar is going to go up past 103, the DXY, and other people think it's going to drop down to 70. Well, I think that whatever happens, there is going to be volatility in the U.S. dollar. Why not buy a debit spread on both sides? If it costs you $500-600 and you have the potential to make $100,000 on the trade, it doesn't matter which way it goes. It just has to move. That's the bottom line. The bottom line is you can play both sides if you want. You don't have to just pick a side. So, but the bottom line is you keep an eye out for these type of macro events or potential black swans, both in the economy, interest rates, US dollar, stock market, and individual stocks. I mean, hey, look, if you can find one of these on Tesla, for example, why not?
Right.
Tesla moves. Yeah, it can move. You could play both sides. I mean, if it's $500-600 risk, you just want to pick a high flyer that really doesn't have any basis in reality. I'm not saying Tesla is like that, but I'm just saying that like Tilray. I mean, I don't know if you got time to bring up the chart of Tilray.
Got a minute here. TLRY, right?
Yeah. Now, one asymmetrical trade that I'm looking at right now is the one I posted also in the RTUS update, was this KSHB. I mean, it's trading at 58 cents. It used to be $5-7. If you buy 1,000 shares of that, your maximum risk is $580.
There's your weekly chart on Tilray.
Yeah, look at Tilray hit $300. Now wait a minute. I mean, if I'm looking at this thing and I see this is really hype. There are some stuff. I mean, no rational person is going to continue to bid up a stock that went from, what was that, like $20, $38? Yeah, $25. I mean, 23 to 300. It doesn't happen. That's an asymmetrical trade. If you bought some puts, as that thing was going up, the volatility was dropping like a rock. You could have gotten puts on that probably like 9 months out. So what was that? That was 9/17. You could have bought them probably for March or April. What was it trading in March and April of the following year?
60s.
60s. That's an asymmetrical trade. Buy puts on a stock that goes up to $300 from 20, and you're looking at an asymmetrical trade of buying some nice. You try to get as wide a spread as you can for the least amount of money, but you do want to do a debit spread though. You want to have a short call and you want to have a long call or a long put and a short put on there. You want it to be a debit spread. You just don't want to buy puts. That's just going to lose more money. You want the debit spread as low as you can get for the widest spread you can get. So if you could get, let's say, 100 to 50, that's a 50-point debit spread on that, and you could get it for 15 cents and it explodes to $50. That's a huge payoff for a very low amount of risk.
Yeah, because this whole week, depending on when this was running up, those were going down and down and down and down because nobody thought, hey, it's going to the moon.
Yeah, exactly.
What could go wrong here?
That's right.
So that's the tricky part. I shouldn't say tricky part, but that's the key, I would say as well, Andrea, is when you're seeing stuff like this, and obviously this you don't know about, think about this being your last bar that you're looking at. People are all just happy. So it's also opportunities that you're going against herd thinking, because the rest of everybody else is just trying to jump in. They think it's going to go to 1,000, because why wouldn't it? At that point, it went from 30 to 300. They'll just keep on going, right? They want to buy more because it's running up. Well, then they get clobbered. So that's where I would say part of the whole grand scheme of things in the thought process, just like, hey, the market's almost at all-time highs again. Yeah, well, something might happen to that. Is kind of what, as the spidey sense is going on, because we don't believe everything that's going on. It's the same kind of thing at this one. Tilray's going to 300. It's like, yeah, that's not reality. That's where you can, think against the grain a little bit and be able to think outside the box and look for those opportunities.
Absolutely. So, keep your eyes open for those real high flyers. Watch CNBC, watch Bloomberg, look at the, just kind of keep an eye on trends. If something goes up 400% in a single day, that really perks me up.
Yep, exactly.
Opportunity here. So anyway, that's an asymmetrical trade, guys. Very, very, very powerful stuff. I mean, I call it a slack adjuster because let's say, you're doing okay, you're making like 20, 30% a year and you're doing okay in your trading. Well, this one it has the potential to go 260 times. So it definitely makes up some nice gains.
Absolutely. Well, Dave, we appreciate all the info on the asymmetrical trade, and I have a feeling this one's going to be a popular video.
I think so too. I think we'll get a lot of emails and comments on this one.
Exactly. All right, gents, thanks for joining us. And until tomorrow, we'll catch you in the chat rooms and send us emails as you got questions.
All right, guys, have a great day.
Thanks, Dave. See you guys.